It's very difficult for a bottom-up fund manager like myself to formulate a conclusive view on the macro trends affecting the sort of ebbs and flows into specific industries, but certainly very cognizant of the fact that a lot of historical investors in gold seem to have allocated capital to cryptocurrencies and to Bitcoin over the past few years. That's certainly been the preferred instrument for a lot of investors to bet against potential inflation or an erosion of the value of fiat currencies. These gold mining companies happen to be in large part headquartered in Canada, and a lot of capital that would have historically flown toward gold mining companies seems to have flown into sectors that have garnered much greater interest in Canada. Cannabis companies, believe it or not, being a case in point. In general, I would say that the management teams in the gold mining sector have given investors every reason not to invest in their companies, right? Management teams in this sector have an extraordinary track record of destroying capital, and that capital has been destroyed basically through terrible investments in exploration projects, but also really destructive M&A over the past few years. So by way of example, the whole sector right now has about $225 billion in market value, and most of the companies in the sector are publicly quoted. So for about $225 billion, you could buy every single gold mine in the world, just about, right? But the top 20 players in the sector alone have destroyed $157 billion worth of capital just only over the past 10 years. This extraordinary mismanagement track record is the biggest reason I can think of why investors have shunned this sector and why they will likely continue to shun the sector unless important changes are made. And we're investing in the sector to effect and to bring about change. Investors have allocated to the sector with on average, pretty terrible results historically, right? Since 2006, I think the price of gold has almost doubled, right? And the average company has lost 50% of its equity value. So investors would have been right to avoid the sector. And that's what's gotten us to a point where valuations are near all-time lows. The price to cash flow that the sector is trading at, particularly in the among the mid-level miners that we look at, valuations are currently at 30% on a price to cash flow basis of what they have been on average over the past 20 years. Why now, you ask? Here are two reasons. One is, in 2020, starting in 2020, almost every major gold miner in the world will have entered a period of declining reserves and productions. Right? And so you think, all right, well, maybe they can offset this declining reserve and production through new discoveries. Well, here's fact number two. We're not finding new gold, okay? Last year, we spent 3 times as much CapEx looking for new gold reserves around the world as we had spent in 95, 3 times as much. We found only 5% of the gold that we found in 1995. And the quality of the gold that we found was 50% measured in grams per ton of what it was in 95. So the majors are running out of gold. They're not discovering any new gold. The only way for them to replace those reserves is through consolidation. And by the way, there's an extraordinarily powerful economic rationale for consolidation. In fact, there are many, but here's one of the most powerful. As a major gold miner, you are trading at twice the multiples on price to net asset value, price to cash flow, whatever metric you want to look at on average. You trade at 100% premium to the smaller players in the space. And so financially speaking, it certainly makes all the sense in the world to consolidate the sector. And then when you think about the fact that the smaller miners have lower margins because they're encumbered with onerous and unnecessary cost structures, all of which at the G&A level can be done away with upon consolidation. You look at an extraordinarily powerful rationale for consolidation, and we think that consolidation has to happen and has to begin to happen before 2020, lest the majors in this space continue to decrease in size. There are many companies in the sector that spend almost, and in some cases over 100% of EBIT on G&A, right? And they trade at half the multiples of the major players in the sector, right? You remove G&A at many of these companies, you double profits. If you look at the number of gold mining companies in any given market cap range, say maybe $1 to $5 billion, you look at the gold mining sector has 3 times as many companies in any given market cap range as producers of other metals in the world, some of which have bigger end markets in terms of yearly sales, right? And so this is a sector that it seems to us, particularly in the mid-cap range of the space, should have a third of the companies that it currently does. So you're looking at, many, many dozens of transactions that need to happen. Just over the past 10 years, the top 20 companies in the sector have destroyed $157 billion worth of capital. Over the same time frame, they've made almost $130 billion worth of cash. And we're looking at pretty stratospheric numbers. And the way that capital has been destroyed is by investing in new and greenfield projects that have yielded very little, and in fact have yielded zero return on capital. Okay? And then here's another big problem with the sector, which I think is maybe the root problem, is that the management teams in the sector have very low ownerships of the companies that they lead, right? Average insider ownership rate, management, top managers, founders, what have you, is about 0.4%. Okay? That's a fifth of the next lowest insider-owned industry that we're aware of, which happens to be in the natural resources space as well. So these management teams really aren't incentivized based on share price performance, but their yearly cash bonuses, which tend to be very generous, are calculated based on how large the reserves of the companies are and how large the production is and how large the production profile is. So what happens is when the price of gold goes up, the share price of their company might go up. Their cash flows certainly go up. The bankers throw a lot of capital at these companies. They use their share price and their cash flow and that capital that's newly available to them to buy the biggest gold mine that they've been looking at buying and that they've been interested in buying and adding to their collection of assets. And for maybe a year, they make a much higher compensation. But when the price of gold then goes down, their cash flows dry out, their share prices decline, and now they have leverage to contend with. And they could potentially face liquidity problems, right? And so they sell the very asset that they had bought, often for pennies on the dollar. And you rinse and repeat this process over a cycle, and you end up with an industry that, even though fundamentally very profitable at the operational level, will, through an extraordinarily non-judicious allocation of capital and business development, destroy the kinds of capital that this industry has destroyed over time.